Hi, my name is Pat O'Connor. I am the broker owner of the Veritas Real Estate Group. We're located in Coral Springs, Florida. Today I want to talk about the capital gains tax exemption when you sell your primary home. Now, if you already sold a home, you're probably aware of this, but if you haven't and you're looking to buy your first home, or you've lived in your home for a while and you have yet to sell it, this is going to come as great news. First of all, the capital gains tax is a tax that the IRS levies on assets and investments that make a profit when you sell them. So an example of an asset would be your house, and an investment might be stocks and bonds. When you sell them, you're going to have to pay the government tax on the profit of those. So the capital gains tax rate for most people is 15% if you hold the property or the asset for a year and a day. So if you hold it, for at least a year and a day, then you can be taxed at 15% tax rate, which is probably lower than your personal income tax. If you hold it for less than a year or less, then you will be taxed as ordinary income. That could be 20% or more. All right. So just holding these things for one additional day can save you a lot of money because of the difference in the tax rate for capital gains. So how does that apply to your personal home? The IRS wants to reward stable homeowners, people who have lived in their home for 2 out of the past 5 years. They don't have to be consecutive 2 years. You can rent out the property in between times. It can be rented when you sell it, as long as you have lived in the property a total of 2 years. The IRS, if you are filing a single return, will give you $250,000 profit tax-free. If you are filing jointly, you can receive $500,000 tax-free. So when you go to the closing, there will be a line at the bottom that'll say money due to the seller, or net proceeds for the seller. So this will be the sale price, the money coming in from the buyer, minus the real estate commission that the seller pays, minus the mortgage payoff if there is any, and then plus additional closing costs, or minus the closing costs. And that will be the net proceeds. And the IRS calls this the amount realized. So if the amount realized is less than $250,000, you don't have to do anything else. That entire amount is tax-free money in your pocket that you can do anything you want to do. You use it to buy another house, you live in that house for 2 years, you can go through all this again. So what if you sell the house and your net proceeds are $300,000? You want to try to be able to claim that entire $3,000 as tax-free money. So how do you do that? The IRS allows you to take deductions from those net proceeds, a variety of deductions. Number one, keep the closing statement from when you buy the house, because you can deduct from that $300,000 net proceeds. You can deduct costs like attorney costs when you bought the house, if you paid for title insurance, if you paid any of the fees that the seller ordinarily pays for, like through negotiations you agreed to pay for them. You can now deduct that amount from the 300. So you're coming closer and closer to the 250, right? For net realized, for the amount realized. Then any repairs, improvements that you have made to the home while you have owned it, keep the receipts. Repairs that you can deduct from those net proceeds, they include remodeling a kitchen, a new roof, new septic system, a sprinkler system, landscaping, anything that's going to add more than a year to the value of the property, right? Planting flowers in the front yard, maybe not so much, because if they're annuals, they're going to die. But putting in shrubbery, sure. Sod, all that kind of stuff with the grass, yes. One thing that's not included is painting the interior and the exterior of the house. You cannot take a deduction. So the idea of this is to make these deductions as large as possible if your net proceeds are over the $250,000 max and you're filing singly. So IRS calls all these deductions and the net result of all these adjustments the adjusted basis. Okay? So sure, you take a, new kitchen, $35,000, had to put in new AC. I added a room to the house, okay? Here we go. So now you're already down to at or below the $250,000. And so that way you can still, you're walking away with $300,000, but for the purposes of the IRS and capital tax exemption, you're netting less because of all the improvements that you have made to the property and the cost that you had to pay when you bought the home in the first place. If you're selling a home and it is on land that you had purchased and you had constructed, you can deduct as part of your adjusted basis the cost of the land and all the material and labor associated with building the home. So that's it in a nutshell. The link to the IRS site that has more explanation will be in the description of this video. But it's terrific. Keep it in mind. Do not sell your house if you possibly can before the 2 years is up. The IRS does have exemptions if you have to sell because you were relocated for work or for health reasons. You can get partial exemptions. So part of it may be tax-free money. So go to the IRS site if you have questions. Talk to your CPA. But the website, IRS website, is pretty thorough. All right, so start planning now. If you're looking to buy your first home, make sure you keep your closing statement. And it can help you when you go to sell your house. Okay, see you next week. Bye.